Considering whether to own a home versus rent in retirement is a complex decision which is often made based on long-held beliefs, sentiments, and other intangible factors that can vary from person to person. But what most retirees don't do is run the actual math, or they think they already know the answer, and that's a mistake, because there is one number that can make or break your decision. Let's run through it with specific examples and real numbers. Sandra sells her $420,000 house at 62 and puts the equity to work in the market. Marcus keeps his paid-off $420,000 house and stays exactly where he is. They both think they made the smarter move. They're both wrong. Sandra forgot to count what her house would have been worth in 20 years. And Marcus forgot to count what his equity could have earned if it wasn't sitting in drywall and shingles. When you actually run the numbers over 2 decades, the gap between them swings by more than $1 million. And it comes down to one number almost nobody checks before making this decision. Let's keep this fair. Sandra and Marcus are both 62. Both have $420,000 in home equity and a $600,000 investment portfolio with a 60-40 mix of stock and bonds. The 60-40 portfolio has an average nominal return rate of 7 to 8% over the last 20 years. Both need $5,500 a month to live on before housing costs. Same city, same market, same retirement age, same health. The only thing that's different is what they do with the house. Sandra sells it, adds the $420,000 to her portfolio, and rents. Marcus stays, keeps the mortgage-free house, and leaves his $600,000 exactly where it is. Before we run a single number, it's worth naming the thing that's actually driving most people's decision here, because it usually isn't the math. For a lot of people, a paid-off house isn't just an asset, it's the finish line. 30 years of payments, and you finally own the thing outright. Selling it can feel like giving that up. And renting still carries a stigma for this generation that owning never did. Like it's a step backward instead of a financial decision like any other. We're going to set that aside for a minute and run the real numbers first. We'll come back to it because it matters, just not as much as people think it does. On paper, day one looks like a clean win for both of them, which is exactly why this decision is so hard. Sandra looks at her account balance and sees $1,020,000 instead of $600,000. That's a 70% bigger portfolio overnight, without taking on a single extra dollar of risk beyond what she already had. It feels like she just unlocked money that was sitting there doing nothing. She tells her sister on the phone that week, "I finally get to use it. It was just sitting there." Marcus looks at his monthly expenses and sees almost no housing cost at all. Property tax, insurance, and maintenance on his $420,000 home run him about $967 a month combined in year one. No mortgage, no landlord, no rent increase notice showing up every spring. He drives past the house on his way back from the grocery store and thinks, "I own this. Nobody can raise my rent, and nobody can ask me to leave." Here's the part that surprises most people running this comparison for the first time. Sandra's starting rent on a comparable place is about $1,800 a month, nearly double what Marcus pays to carry his home. So in year one, keeping the house is actually the cheaper monthly option. The popular version of this story assumes renting starts cheap and slowly gets expensive. That's not what the numbers say. Renting starts more expensive. The question is, what happens to both sides over the next 20 years? And that's where almost every online version of this comparison stops. Both of them are also right about something real. Sandra's friend sold at 64, moved into a rental near her grandkids, and has said more than once that she's never taken on a home repair bill again. Marcus's neighbor across the street is 71, still in the house he raised his kids in, and tells anyone who'll listen that the 2 happiest financial decisions he ever made were paying off that mortgage and never looking back. Both stories are true. Neither one is the full picture. But feelings and math are 2 very different things, and only one of them is about to change depending on a single number neither Sandra nor Marcus has actually looked up. The bigger portfolio is the number everyone talks about on day one. It's the number that feels like a win at the closing table. What nobody talks about is what that money, and Marcus's house, actually have to do over the next 20 years to prove that first-day feeling right? Here's what nobody tells you. This comparison isn't really rent versus mortgage. Marcus doesn't have a mortgage. It's rent versus nothing, plus two assets that are both quietly compounding in the background: Sandra's portfolio and Marcus's house.
Start with rent. At $1,800 a month, with rent inflation running at 2.9% a year, that's the actual Bureau of Labor Statistics figure for May 2026, not the 4 to 5% a lot of people assume based on the post-pandemic spike. Sandra's rent grows to $2,018 a month by year 5, $2,328 by year 10, and $3,099 a month by year 20. That's already a smoother climb than the 4 to 5% assumption most retirement calculators default to. If you're modeling your own numbers and you're still plugging in the pandemic-era rent spike as your long-term assumption, you're overstating your own rent risk. Marcus's costs move too, just from a much lower starting point. Property taxes climb roughly 3 to 4% a year nationally. Maintenance tracks close to general inflation, which BLS pegged at 4.2% in that same May 2026 report. Run those forward, and Marcus's monthly carrying cost goes from $967 in year 1 to $1,091 by year 5, $1,275 by year 10, and $1,766 by year 20. His home insurance is the one line item we're holding flat in this model at roughly $2,400 a year, the 2026 national average, and that's almost certainly generous. Climate-related risk is already pushing insurance costs up faster than general inflation in a lot of markets, and in some, insurability itself is becoming the real risk, not just the price. If Marcus lives somewhere that's seeing carriers pull out or non-renew policies, his real number could run well above what we're crediting him for here. Worth checking your own zip code before you assume flat. Now, here's the part that gets left out of almost every version of this comparison online. Marcus's house is not a static number sitting in a drawer. It's an asset, and assets that aren't cash tend to grow. Nationally, home prices have appreciated a little over 4% a year on average over the long run, according to Case-Shiller data. That's a long-run average, and it varies significantly by market, so treat it as a starting assumption to replace with your own local number, not a guarantee. At 4% a year, Marcus's $420,000 house is worth $510,994 by year 5, $621,703 by year 10, and $920,272 by year 20, without him doing anything. So the honest hidden reveal isn't rent inflation quietly wrecks Sandra. It's this. Both sides of this decision are compounding assets, and the entire outcome depends on which one compounds faster, Sandra's portfolio or Marcus's house. Here's where the story separates. I ran this as an actual year-by-year simulation, not a rough estimate, tracking both of their portfolios, Marcus's home value, and every cost on both sides, compounding annually for 20 years. And the turning point isn't a year, it's a rate. Compare Sandra's investment portfolio return to Marcus's 4% home appreciation, and the break-even point, the exact return where both paths land in roughly the same place after 20 years, sits at just about 6%, a little over 6%, and Sandra's bigger, more liquid portfolio starts pulling ahead, and the lead compounds every year after that. Under roughly 6%, Marcus's paid-off house, with no rent, no landlord, and a value that keeps climbing right alongside Sandra's account, quietly wins, and its lead grows too. That's not a hedge, that's the actual mechanism. Everything else in this video is what happens on either side of that line. Let's look at the numbers through year 10 and year 20 under three portfolio return assumptions: conservative, base case, and optimistic. The same range Morningstar and T. Rowe Price use in their long-term retirement return studies. Conservative, 5% average annual return. At year 10, Marcus is ahead by $78,130 in total net worth. By year 20, his lead has grown to $214,912. Below that 6% line, the paid-off house wins, and it wins by a wider margin every year. Base case, 7% average annual return. The picture flips. At year 10, Sandra is ahead by $50,715. By year 20, her lead is $205,394. A 2-point difference in assumed return is the entire ballgame here. Optimistic. 9% average annual return. Sandra pulls decisively ahead, up $204,141 by year 10 and $818,843 by year 20. That's the swing I mentioned at the top, from a $215,000 loss to an $819,000 win, and the only thing that changed between those two outcomes is the return on Sandra's portfolio. And recall that the average growth of a 60-40 investment portfolio over the last 20 years is 7 to 8% a year.
Check the year 15 mark too, because it's where the gap really starts to separate from the pack in every scenario. Conservative, Marcus up $137,658. Base case, Sandra, renting, is up $108,705. Optimistic, Sandra up $433,167. Between year 10 and year 15, the lead in every single scenario grows faster than it did between year 1 and year 10. That's compounding doing what compounding does. It's slow enough in the early years that both of them could plausibly ignore it. By year 15, it's not ignorable anymore. In 2 of the 3 scenarios, renting wins. Notice what's actually driving that spread. It isn't the housing costs. Those move by a few $100s a month between scenarios. It's compounding on a $420,000 head start. At 5%, that extra $420,000 in Sandra's portfolio barely outruns a 4% appreciating house once you subtract her much higher rent. At 9%, that same $420,000 nearly doubles what a 4% house can do over 20 years, even after paying rent the entire time. Small differences in assumed return don't move the answer by a little. They move it by hundreds of thousands of dollars, because they're compounding on the single largest asset either of them has. One honest caveat on this model, because accuracy matters more than a clean story. These figures assume both of them are funding their full $5,500 a month living expenses plus housing costs entirely out of their portfolios, with no Social Security or pension layered in. For most real retirees, Social Security covers a meaningful chunk of that base spending, which would slow the drawdown on both sides. But it doesn't change the comparison between them, because it affects Sandra and Marcus equally. The gap between their 2 paths is what this video is measuring, and that gap holds regardless of what else is funding the rest of their retirement. If you're modeling your own numbers, plug in your actual expected Social Security benefit before you panic about either of these portfolios running dry. If I only showed you the scenarios where Sandra the renter wins, I'd be doing exactly what every sell your house and invest the equity influencer does. So let's give Marcus's path its due. His approach wins outright in the conservative scenario, but even in the other 2, where the average return favors Sandra, a bad market in the first few years of retirement can flip the outcome in his favor. Averages are what happen over 20 years. Sequence is what happens to you. A paid-off house is not just a return assumption, it's a floor. If the market drops 30% in Sandra's first 2 years of retirement, and sequence of returns risk means an early downturn does far more damage than the same downturn 10 years in, because she's pulling rent payments out of a portfolio that's already shrunk by a third. Marcus isn't affected the same way. His housing cost doesn't care what the S&P did last quarter. Nobody can foreclose on him for missing a rent payment because there's no rent to miss. There's also no re-qualifying for a lease at 75. No landlord deciding not to renew. No forced move because a building got sold to a new owner who wants to convert it. A paid-off home is one of the only assets a retiree owns that can't be margin called, repriced overnight, or taken away for reasons that have nothing to do with them. And there's a second piece of fair witness worth naming. Aging in place has real, unavoidable costs on Marcus's side that this model doesn't fully capture either. At some point, most homeowners face a remodel, a walk-in shower, a stair lift, a first-floor bedroom conversion, to accommodate mobility changes as they age.
That's a real cost. It's specific to the house path, and depending on scope, it can run anywhere from around $3,000 for minor modifications to $15,000 or more for a full accessibility remodel. Worth budgeting for specifically rather than assuming the house stays maintenance flat forever. Sandra, by contrast, can simply choose her next rental based on what her body needs at 75, without renovating anything. If you're the kind of investor who checks your portfolio during a downturn and can't sleep, the security of a paid-off roof has real value. Value that doesn't show up in a net worth spreadsheet, but shows up in every other part of your life.
So here's the actual verdict, not the easy one. Selling and renting wins when your realistic, long-term portfolio return sits comfortably above 6%. When you have the temperament to ride out a down market without panic selling, and when flexibility, the ability to move, downsize further, or relocate near family matters more to you than owning the walls around you. Keeping the house wins when your return expectations are more conservative, when your house is in tip-top shape and unlikely to need any major system repairs or an aging-related remodel, and housing cost certainty lets you sleep at night, or when your local market's home appreciation is running hotter than the national 4% average we used here. But the real decision isn't only the return rate math. There's a psychological layer underneath both choices, and it deserves as much honesty as the numbers did. For a lot of people, a paid-off house isn't just shelter. It's 30 years of payments finally behind them, proof that they made it. Selling can feel like giving that up, even when the math says otherwise. And renting still carries a stigma this generation didn't grow up with, even though renters, in this comparison, get something owners don't. No maintenance hassles, no surprise roof bill, and often amenities like a fitness center or a built-in social community that a lot of retirement-friendly rental buildings now offer. Neither feeling is wrong. They're just not line items on a spreadsheet, and you should know which one you're weighing before you run the numbers, not after. Because a decision that's technically optimal but keeps you up at night isn't actually the optimal decision for you. There's also a bigger picture number worth sitting with. For most people this age, home equity is the single largest piece of their net worth, and it's wealth that sits on paper. It doesn't produce income. It doesn't pay for a trip, a grandchild's wedding, or the active years of retirement when your body can still do the things you've been planning for. The real question underneath sell or keep is sometimes simpler than a spreadsheet. Are you house rich and cash poor, watching your most active retirement years pass by because your money is locked up in a structure instead of available to you? That's not a math question, it's a values question, and it's worth answering honestly before the numbers even enter the room. If neither extreme sits right, there's a middle path worth modeling on your own, downsizing instead of fully cashing out. Sell the $420,000 home, buy something smaller for $250,000, and invest the $170,000 difference. You keep the security and the appreciation of owning something while freeing up real capital, without taking on Sandra's full rent exposure or Marcus's full illiquidity. I didn't run a full simulation on that path in this video, but the framework here gives you everything you need to build it for your own numbers. Here's how to actually run this for yourself. Step 1. Get your own numbers, not ours. What's your home actually worth? What would it rent for? And what's your realistic long-term portfolio return net of fees and taxes, not the number you're hoping for? Step 2. Check your local home appreciation trend, not the national 4% average. Some markets have run colder than that for a decade, others have run hotter, and that single input moves your break-even rate up or down. Step 3. If you're on the sell and invest side, calculate any capital gains exposure before you count the full sale price as investable. The IRS excludes up to $250,000 of gain for a single filer or $500,000 for a married couple filing jointly, but anything above that is taxable and reduces what you actually have left to invest. So don't assume your entire sale price walks into the market untouched. Step 4. Once a year, check your portfolio's real return against that roughly 6% line and your home market against your local appreciation trend. If the spread between them shifts,
the right answer for you can shift too. This isn't a decision you make once at 62 and never revisit. It's one you can quietly recheck every year with about 20 minutes, and the numbers from this video. The real trap isn't selling, and it isn't keeping the house. The real trap is deciding based on which choice feels like the finish line, or which one feels the safest, without ever running the actual numbers for your own portfolio, your own local market, and your own tolerance for risk, and finding out 10 years in that the number you were sure was fixed was never fixed at all.
Tell me in the comments, are you leaning toward keeping the house or selling and renting? Not to be judged, genuinely, because the first step in getting this decision right is being honest about which one you're already leaning toward and what your concerns are before you've run a single number. If this showed you the math you'd been missing or gave you a better framework to help you make your decision, please click like and subscribe, turn on notifications, and we'll keep making valuable videos.